my friend Ranjan. So, Vincent, yep, you can come, and then Ranjan, I guess first seat and second seats. Yep. And Ranjan is the next moderator for another great session. Dr. Ranjan Bhaduri is an ex-academic and well-known figure in the world of finance in Canada. And if you haven't had the opportunity to listen to his podcast, I think you should go to his website. He has amazing podcasts that he continues to produce on an ongoing basis. So Ranjan, I'll let you introduce your.
So, thank you very much, Francois and Marco. That was fantastic. No surprise. And just so everybody knows, Marco took a lot of effort to be here. He drove overnight from Boston. A corollary of the Air Canada strike. And so I want to also thank Alec. He flew in from Washington, D.C. And Vincent, of course, honorary president, has already been introduced. Alec has, I think, a quarter century of experience at Goldman Sachs, has been a managing director there since 2012. Is the chief political economist covering the U.S., and really we're in for a treat. But before we dive in, I do want to give another shout out to Claude. Claude Perron is the driving force. He had the vision, he had the execution, the implementation, everything. For years, I've been calling Claude Jean Beliveau. Who's the winningest Montreal Canadian in history in terms of number of Stanley Cups, and his grace, his elegance, his talent. All, first time I met Claude, I got reminded of Jean Beliveau. But I'm starting to also maybe add Mick Jagger because, the energy that he has is really, really inspirational, right? So it's... We got Jean Beliveau and Mick Jagger in Claude, and so again thanking Claude, thanking all of you for being here, and my name is Ranjan Bhaduri, founder and CEO of Bodhi Research Group. We help sovereign wealth funds, pensions, single-family offices on different portfolio matters in advisory and research. So this panel is going to be, in some ways, two different kinds of topics, right? Like we're going to cover some more political economics and with the U.S. focus, and we're also going to cover liquid markets. And given who we have, it would sort of be wrong not to do that. With Vincent, it's tremendous to get that opportunity to ask him questions on the liquid markets. But overarching, both of these subtopics go into breaking through uncertainty. So that's so we are going to pivot a little bit. Alec, we just had a brilliant presentation by Marco. If you could just make a color commentary on that, just to start it off, please.
Okay. Sure. So I would say, just thinking about, well, first I will say I was surprised to hear that he did not think that Ukraine and some of these other issues really matter. And I was refreshed by it because I kind of agree too. I mean, we spend so much time talking about these things, and yet ultimately, not only if you look at sort of what has happened in the last few years, and yet then where we are in markets today and in economic growth, but also look at even just energy prices and the things that should matter most when thinking about some of those geopolitical issues. They just haven't as much. With that said, and Marco didn't say this, but I do think that there are kind of more fundamental economic policy issues that do matter and that do end up impacting growth and markets, and so the sort of the things like tariffs, fiscal policy, because those things, unlike some of these kind of more fleeting, ultimately strategic and military issues, are, they're actually at the core of what he was talking about, which is things like the capital account and the current account. I would say if I had to pick one place where I maybe have a different point of view, it would be on the idea that fiscal policy and that the large U.S. fiscal deficit has driven growth over the last, whatever you want to call it, decade or more. The reason I disagree with that is just, and it's not to say that it isn't contributing to a higher level of output, but there's a level versus a change thing. And when we think about the rate of growth, we're thinking about the change. The change in the deficit has been basically zero for the last, call it, few years, more or less. So while we're in an unsustainable position and we're running an economy that's probably hotter than it should be in terms of the level of output, I would differentiate between that and growth depending on unsustainable policies. It's not to say that they're not unsustainable, that they are sustainable. But that's one place where I would maybe have a little bit of a difference. I could sort of go on some of the different topics, but I think those are probably like a couple of the main points.
No, fair. Marco, do you want the last word? I'm just joking. Okay, so Vincent, I'm going to start by asking you the following question. Like I've said it before, Canada is world-class in a few things. We're world-class in ice hockey, both men's and women's. We're world-class in women's soccer. And then we're world-class in pensions. We really, truly have been, and this goes back decades. But there's success, surviving success, and trying to have that continued success. And that's what I want to start by asking you. What is it going to take, for Canadian pensions in general to stay ahead, to stay innovative, to stay, to be able to be creative? So, please.
Yeah. Certainly when I think about my time as a sell-side analyst like Marco traveling around the world, it was my first time I realized how the rest of the world admired the Maple Leaf, the Canadian Pension Fund model. And now I've had the opportunity to work for La Caisse for the last 5 years. I've come to witness it firsthand. So, a strong track record, a model that was trailblazing when it was erupted a few years ago. Very different from the way the Americans run their pension fund models. Very diversified, internal teams, cost efficient, a lot of emphasis on private assets. What it's going to take to keep that edge for Canadian pension funds, and that's areas that we're talking about constantly internally, is to realize that things are different now, and they will be different 5 to 10 years from now. Like Marco's pitch on the geo being noise, on a short-term basis, but the longer-term trends really having an impact on. I think that's one of the keys that we would need to be looking at, as the Canadian pension funds. The geo has changed. The volatility and rates have changed. Public markets, the liquidity premium, private assets, the premium which has gone down. So these will all be very, very challenging for the Maple Leafs, the pension fund model. I think we can continue to be world-class, but definitely coming to realize that what got us here won't get us to 2030 or 2035. And if I just look at the realm of what I supervise at CASE, public markets, public equities, the way we run public equities today is completely different from how we did it 5-10 years ago. Our fixed income book is completely different. The emphasis now on alternatives, on absolute strategy. So not being afraid to have the right diagnostics, what the reasons why pension funds have been successful in Canada. Are we in a different environment? My answer would be yes. So making sure that everybody challenges themselves to think about how you evolve for the future.
No, fantastic. And one of my reasons for optimism with regards to the Canadian pensions is the incredible depth, right? So there's a lot of very talented people at La Caisse and several of the other Canadian pensions, and I often look at hockey analogies, and the Blackhawks were a mini dynasty, and now they're in the bottom, but they didn't have that same kind of depth on their defense, and when the defense eroded and aged, they didn't have the right replacements. I'm gonna stick with you, Vincent, and ask you the following question. I'm gonna give a quote from Warren Buffett. "I would rather be certain of a good return than hopeful of a great one." And then I'll state the following fact, that most active long-only managers, or PMs, fail to beat the index over the long run. There is also the opportunity cost in spending resources for active long-only. What are your views of active versus passive?
I think about this constantly, on a daily basis. And one of the things that I'm going to, have follow on to your previous questions, I think one of the things that's changed the most, in my opinion, is that the belief that you can be in a buy and hold environment will come true. Honestly, if you look at an S&P 500 chart for the last 10, 20, 30, 40 years, you would have to convince me that buying and holding, having the same thesis, the same conviction on a very, very lengthy time span will actually work out. Because you don't know how quickly or not the market will be able to price it. The reason I'm pointing this out is because if the market's more volatile and these mini cycles occur more frequently, then you need to be more agile. Whether it's a Canadian pension fund or a hedge fund, anybody, you need to be more agile. And then your strategic decisions, so the frontier between what's strategic and what's tactical, I think becomes blurred. So again, your point. So strategic allocation from Marco is let's underweight U.S. For the next 5 years, position EFI and China. I would agree with that. What happens if that trade works out in the next 12 to 18 months? It could do. Do you stick to that strategic view just because it was strategic? So turning out to the active versus passive, we mostly think about active versus passive when we look at long-only or external managers. You need to beat your benchmarks. But the beta and alpha decisions within pension funds, I think, has become increasingly important. And that's the way we've separated it. When you look at our public equity book, historically, we were only thinking about beta. You need to outperform the MSCI World. You need to outperform the S&P TSX. Now we're at the stage where we do have these mandates where if I'm allocating money to you, the Canadian PM, you need to beat the TSX. But the biggest decisions, the strategic beta decisions, have been made previously, and they are as, if not even more important. And for us, it's helping because it takes us take a step back from looking at this active passive just in terms of how our long only or hedge fund managers are doing, but putting the onus also on the ones that are constructing the portfolio.
Fair. No, excellent. Thank you for that. Definitely agree that there's a lot on the asset allocation side. Alec, this question is going to be probably the most eagerly anticipated from the audience. If you had to flag one U.S. policy development in the next year that could catch investors off guard, what would that be?
So I will say I don't have a brilliant answer to this because Trump has talked about just about everything already. So I don't know that there's a lot that can really catch you by surprise. I mean, I would say the thing that has, even though it has been very much in focus and sort of at the front of some of the news coverage recently, it has not actually changed very much yet, is the impact on the U.S. economy from, we've heard about tariffs, we've heard about the fiscal policy, but from the immigration changes. And it's certainly possible that, I won't get into the detail on all the policy changes, but it's certainly possible that by next year we could end up having, net negative migration in the U.S. and a much sharper slowdown in essentially the overall population growth than what people are expecting. And just to put one number on that, the fiscal package that passed recently had in it around $150 billion of additional money to enforce immigration laws, essentially deportations, among other things. That's about roughly 10 times the annual budget of the agency mainly responsible for this stuff. That hasn't actually really started yet. And so I think that's going to be the thing. And just to think about why that would matter in terms of the growth impact that will weigh on growth. It'll matter in terms of the jobs impact. It will reduce monthly jobs numbers. It will impact the unemployment rate. It could have implications for inflation. So that's probably the one thing. We've seen the tariffs happen. There's nothing really, we should talk about it, but at this point, the surprise is there. It's kind of hard to see where the surprise comes from. Fiscal, we can talk about, but there again, not as much of a surprise. But I think the immigration thing is probably the one that might catch people.
Very, very, very interesting. I'm going to give the following true disclaimer before asking Alec the next question. I'm neither Democratic nor Republican. I'm Canadian. I've lived a quarter of my life in the U.S., in Honolulu and Chicago. I love America. I love Americans. But so with that, true disclaimer, I'm going to ask you about something that I didn't think I could ever ask, right? We've seen serious signs of democratic erosion in the U.S. from the January 6th insurrection to efforts to undermine electoral integrity, and this isn't just always a partisan issue, right? At the same time, the U.S. is backing increasingly authoritarian policies abroad, such as shielding the Israeli government from accountability in the Gaza conflict and in other conflicts that they've initiated in the Middle East. Taken together, how should markets be evaluating the long-term political risk of a U.S. that appears less committed to democratic norms at home and abroad? Could this damage the credibility of U.S. institutions, both domestically and globally? And what impacts, for investor confidence, do you see?
Well, that's a big question. I think it is something that a lot of people are thinking about. And I guess I would think about it in a couple of ways. One would be just thinking about how much of this is sort of like a cyclical, call it a political cyclical effect from essentially Trump and maybe the sort of the America First movement, et cetera. And how much of this is more of a structural phenomenon. I do think that some of what's happening right now is definitely, I think we can say specific to Trump, not even just sort of the MAGA movement, but really Trump specifically, and kind of around his style of, pushing boundaries and pushing norms that even other people within his administration would not have pushed. And I think I don't know the answer to this question, but I think the question is, after he goes, and let's say, for example, let's imagine J.D. Vance ends up winning the presidency. Would a Vance administration pursue all of those same policies and make some of those same decisions? For example, go after members of the Federal Reserve, fire the BLS commissioner, some of the things that have been in the news recently? I'm not convinced that you would see all of that. So I think in that sense, some of what we've seen, very recently that's been sort of in front of markets is, I don't want to say it's isolated to Trump, but it's definitely exaggerated under Trump. But then, and this sort of goes to what Marco was saying before about how some things don't really depend on Trump versus Harris or whatever. I mean, we have had this much more general movement away from trust in institutions, reliance on expert opinions, and other things like that, that it's not just limited to the U.S. It's happened in many places, but it is very visible in the U.S. And that, I don't think we're going to get back. That, I think we're, on this path where there is just less trust in institutions that that the public generally trusted, say, 30 or 40 years ago. And it could be, if you look back at the political commentary from like the 50s and 60s, the complaint was that there wasn't enough polarization and that, there was not enough of sort of a challenge to some of these institutions. And now we've gone, fully the other way. So I think that is something that's going to be with us for a while. And the question is how far it goes. Right now, I don't think we're actually at the point where democracy is at risk. I guess you can always say there's some small risk, but I certainly don't think it's a major risk. I think we're going to have an election in 2028. I think whoever wins that election will win it essentially fairly, and I think that person will take power. But I think the thing that is at least a little bit concerning, and we saw this, I think around the Liberation Day announcements in April, where you saw this kind of strange correlation, people pulling out of dollar assets. Some of it, some of it might have been because of growth differentials and other things, but I think some of it was about not just the policies in question, but like the policy-making process and the sense that something had kind of changed more substantially. So to me, it's a little bit less about democracy, and it's a little bit more about institutions generally, clearly weakening. Some of it, I think, will reverse, but the longer-term trend, to me, seems still likely to continue.
Well, I hope the U.S. stays democratic. I mean, it's been the example of freedom of thought, freedom of action, and some of the things that are happening are definitely very contrary to that. The mathematician Terence Tao was recently targeted, and for those that are mathematicians here, Canada should be just like this is it's outrageous in some sense what some of the academic freedom, at least in my opinion. But going to switch now to the liquid markets, which is easier. And again, Alec, we're really grateful to you for your insights. Like this is a tremendous treat to get your viewpoints on these matters. Vincent, I'm going to go to the heart of the matter with regards to the following. It's from a behavioral finance perspective. It's human beings tend to underestimate the value of liquidity. So this has been proven, and so how do you at La Caisse, like how do you measure the illiquidity premium? Like what do you think it should be, or how are you going about making sure that you're getting, there's nothing wrong with investing in illiquid assets, but you want to make sure that you're getting paid properly for that, even when you have a long time horizon. And so that value of liquidity, how do you and how does your team think about that?
I think liquidity became, erupted on everybody's radar screens in 2022, especially for the Canadian pension fund model, where we have a lot of assets in private assets. So 2022 yield spike, the S&P drops by 20%, and then you need to rebalance on a monthly basis. And you rebalance by usually selling bonds that have gone up and moving them into equities, but now everything was moving lower. So I'd say 2022 was a big wake-up call for pension funds everywhere around the world, in the sense where private assets, so being illiquid, helps you until it doesn't. And I'll be very, very honest, the academics behind the liquidity premium, I think it's hard to prove. Private assets, pay off if public markets collaborate. So we have the discussions internally every single week. Is there still a private equity premium? We believe there is. But there's only one way to find out. The S&P has to collaborate. So that private equity premium has been taken hostage by the S&P, by 20 stocks, by 7 stocks. So the academics behind how we construct the portfolio when you interact with real life, what is going on, for me is a big question mark. We have a lot of private assets in fixed income, obviously a big private equity book. For our conclusion is that there is still a liquidity premium, but it's much, much lower than it was 5-10 years ago. Yields are much higher. And with more volatility, you want the flexibility to adjust the portfolio. So the good news in 2022, markets go down, private equity doesn't go down. Bad news is you can't buy as much equities because you got a lot of money tied into infra, real estate, and private equity. So that was, if I had to sum up my point initially on how things have changed for pension funds around the world, not only Canadian pension funds, if what worked from 2010 to 2020 ain't working for the next 10 to 15 years, you got to revisit how you allocate your betas.
No, very, very true. And Mark Anson wrote a really good paper, a classic paper about that, about private equity really being levered beta with a lag. And you mentioned agility, and really, again, being in Montreal, I think Montreal and Edmonton are the two cities in the that are most hockey knowledgeable on the planet. So I don't apologize for giving
Toronto.
Toronto, no, no, not Toronto. Toronto, yeah, but it's totally fine to do, to sign up to lock up a McDavid for a 8-year contract and have a no trade clause and have that illiquidity make that commitment. But if you have too many no trade clauses, you just don't have that flexibility to manage the cap. And you mentioned the importance of agility going forward, and Marco also mentioned that. And so is that going to be like agility? I equate that to liquidity. And is that going to be even more important given the heightened level of uncertainty?
It absolutely is, because in a world that's more volatile, where you have these big mood swings, and one of the things, when I meet our clients or I talk to people, most people talk to me about the stock market being very, very volatile. When you look at how bonds and the bond market's been volatile in the last 2-3 years, this is not what we signed up to. Nobody signed up for that. Nobody allocated 20-30% of their portfolios in an asset class that was supposed to be your best friend and has been as volatile. So absolutely, the current environment, the need to be agile, to reallocate, puts the onus on, I think it caps the weighting of private assets that you have in portfolios.
Oh, excellent. Now, it's private equity distributions have plunged. There really have, like since 2016, there haven't been nearly as much distributions, and part of this has been due to a disappointing IPO market in the U.S. So I'm going to ask you, Alec, from a political regulatory lens, do you think that this anemic IPO markets, are there going to be any policies that you see sort of helping increase the IPO market in the U.S.?
So I would say, at the start of this year, there was a sense that things were going to come in very strongly, and that you'd have, elevated deal volume, essentially on the back of the Trump administration, and the idea that maybe regulation would be eased from an antitrust standpoint specifically, but then also the idea that sort of the business environment more generally would be conducive, and that would be, a reason that you'd see increased deal flow. And what ended up happening is everything just froze, essentially because of the uncertainty, largely, I think, around tariffs and all of that, and then because of that, the uncertainty around the growth outlook more generally. What we have, seen, though, is that the pipeline of deals and the diligence ahead of deals has been actually still very strong. And so our, sort of general assumption is that we will see a lot of the deal making that, presumably should have happened in the first half of this year still come through, and that this is more of a delay rather than any kind of secular shift or anything like that. I will say, the one place where you mentioned the regulatory aspect, I think the one place where things have gotten a bit confusing, and this in some ways goes back to your earlier question around institutions and all of that, is in the first Trump administration, there was a sense that antitrust policy was, maybe a little bit easier than under the Obama or than under the Biden administrations. And so, in the sense that Republicans may be a little bit easier in that sense. But it was also seen to be much more idiosyncratic, and it was a little bit more selective and maybe a little bit more political. And, there have been some reports recently, and there was, just as one example, a pretty high-profile person just left the Department of Justice over political interference, basically, in antitrust. So I think, some of these questions even go to things like this, which you think would maybe be a little bit more mechanical, and that does create some uncertainty. I don't think it necessarily means that you won't see deals happening, but it creates some uncertainty around, which deals get cleared and which don't.
Interesting. Well, thank you. That's. I'm going to ask Vincent about absolute return strategies. So, where do you think that they fit in with respect to its role for the total portfolio? What is the role of hedge funds and absolute return strategies in your view?
They play a very, very important role. Decorrelation to the other asset classes, portable alpha. It reduces the risk of the total portfolio. And that's certainly one area where we have been working very hard in the last 2 years to increase our exposure to global macro, equity long short. So it is, I'm in charge of public equities, fixed income. They need to beat their benchmarks. We need to choose the appropriate betas. So there's a lot of things going on in these two portfolios. On top of that, when you have a few $1 billion in overlay in hedge funds that can help on a rainy day and decorrelate, lower the risk of the portfolio. I think it's a very attractive strategy.
Thank you. So Marco actually talked quite a bit about this, but I will ask the question nonetheless in a little bit of a different context or format. In general, it's a lot harder to build something than to destroy it. You could be taking decades, even centuries, to build something, and you can destroy it quite quickly. This is something that, in a lot of the, it's well known. I mean, in India, there's scriptures about this, and it's something I ask for Alec, is that the U.S. has increasingly isolated itself on the global stage. The tariffs, the trade wars, tearing up agreements in terms of, like, you know, there was an agreement already in place with Canada, and now it's being torn up and so forth. The unwavering, perhaps obstinate support for the genocide in Gaza, right? In the summer, a draft resolution was introduced in the UN Security Council calling for the immediate and permanent ceasefire in Gaza. 10 elected council members backed it, and despite the support, the U.S. cast a veto, blocking the resolution from passing. So the world's a pretty big place, and given how the U.S. is doing this, and this isn't about Republican or Democratic. Netanyahu went to Congress and got a standing ovation from both Republicans and Democrats, like puppets. It was rather alarming to see that. It's very rare for the Democrats and Republicans to agree on anything. So, do you view that the U.S. is pushing, the rest of the world to look at each other and make deals, and could this be, with a global disillusionment in terms of that maybe there's going to be more deals with China and South-South trade networks? What's the long-term risk to U.S. influence and the stability of U.S.-led systems if these trends continue? Because without a doubt, the U.S. is the superpower today. Without a doubt, the most innovative companies have been coming from the U.S., but it goes, the other part of it is, can it be destroyed, really quickly? And where, when you have at the helm somebody who made his casino go bankrupt, it doesn't lend itself to a lot of confidence. So again, you're a very good sport to take these questions,
So I will say, off the bat, I will say, I think Marco made the point that it's not about friends and enemies, it's about interests. And I would have said the same thing. I think that in the end, there are clearly benefits to having, deep, long-term strategic alliances with like-minded allies. Putting aside Canada, think about U.S.-EU relations. And I think Biden, when he was in office, tried to get that back after some damage to some of those relationships during the first Trump administration. I think the second Trump administration will push, much further in the direction of weakening those alliances. And to your point, I think it is hard to rebuild after, you see this twice. And also beyond that, just given the fact that I think, the U.S. public is less interested now in its global role than maybe it had been at least willing to support 20, 30, 40 years ago. And what Trump has done is to basically call an end to a system that was already in decline, which was sort of the post-World War II understanding. Now, I would say it's not just about international alliances or about the U.S.'s role in strategic issues around the world. I mean, in terms of this idea of it's harder to build than it is to tear down, I think you can also look domestically at some things that have happened, and you can look at the tariff issues. And in both cases, what we're seeing right now is a set of policies that I think will probably have negative long-term implications for U.S. growth because, trade, putting aside the near-term impact, trade increases productivity in the U.S. And to the extent that we have less trade beyond the hit to growth and all of that, in the near term, there will be lasting economic consequences, negative economic consequences from that. Now, I think the Trump administration doesn't see it that way, but I think that is the reality of it. And you can also look at, you mentioned Terrence Tao. I mean, I think you can make the same case on what's happening on the education side, where there was a system built up over decades that actually also started essentially around World War II and research going into the atomic program, where all of this research money was farmed out to universities and it was really efficient. And that is now all sort of seemingly starting to be dismantled. And that was an extremely important driver of innovation in the U.S. So I think those things are going to be harder to quickly replace if they get torn down. But I think, maybe where it's a little less surprising is that you have shifting alliances with other, had-been allies. And what's maybe a little bit more surprising is that you have this tearing down of, economic institutions, which had been really a driver of U.S. exceptionalism.
Excellent. I'm going to ask Vincent one more question, and then we're going to open it up to the audience. I don't want to be greedy where I'm the only one asking questions. Vincent, this is over-under. Over-under on when we'll have a non-human being on the investment committee.
I would say I think it's already happening. I had a few people here in the audience from a team that we built a few years ago. So we run $140 billion in public equities. We've gone from 0 to $35 billion run by our quant team. They're humans. They built the algorithms. But all the data science that is built in the algorithms, the impact it is having on other teams brings us much, much closer to having a non-human on investment committees. I like the subjective aspect of investment committees. I also need the objective aspect that comes from data. So whether you call it a non-human or just the algorithm pushing you out objective data, I think it's already here.
Excellent. Thank you. So, audience, any questions? I can call upon some of you. Hey, Claire.
Question here.
Merci, Vincent and Alec. Would love to hear a little bit more about how your teams are integrating AI and machine learning in the investment management process. I know we just kind of alluded to it here at the end. But equally to projecting out with tokenization and what that might mean for your liquid investment portfolios as private markets are further fractionalized.
Sorry, the question is how we incorporate.
AI and machine learning, like in the spirit of FIAM, can you give us a deeper flavor of how you're integrating that today, and then projecting out any interesting projects, particularly around tokenization and the impact that will have on liquidity for private markets?
Yeah, absolutely. So AI, like most of you in your organization, we are thinking in terms of how it impacts the way we operate. So whether it's HR, whether it's managing public equities, things are moving fast, and we have a team that's dedicated to making sure we have the right tools, that we stay in touch with these advances. And one of the particularities that we have at La Caisse is that the team that's in charge of making sure that our investments are AI savvy, that our processes are AI savvy, that we are data science savvy, is the same team that manages $35 billion using data science. And the genesis of that team was that if data really works, just prove it. So we have, I'm pretty proud of where we are in terms of where I think the low-hanging fruit was in public equities because the data was there. We had some very smart people internally, and we built that out. And now we're responding to other asset classes. So we're looking to do it in credit, public credit, in asset mix, in overlay. We are slowly getting into the long-short business as well, using, I don't want to say AI exclusively, but using data science as the premise of how we build the portfolios. It is going to take a little bit longer for the private assets. Private equity, we are very much in touch with GPs, looking for co-invest. The philosophy there is not as easy to incorporate data science or algorithms than it is if you're managing the S&P 500. But we're trying to make sure that everybody, whether it's in infra, real estate, and private equity, that they learn from the tools that we have learned using managing it in public equities. And ask me the question a year from now, my answers are going to be even more exciting because things are moving very, very fast. But I absolutely believe that the way, you diversify the portfolio through asset classes, you need to diversify it as well in terms of investment philosophies. I was asked a question earlier about how tough it is to beat the benchmark, so active versus passive. The traditional fundamental long-only portfolio manager has had an impossible time using it as toolkit to beat the S&P 500. The quants, the systematic strategies, have had an easier time over the last few years. I'm very happy about that for the quants. It won't last forever. So we need the fundamental guys and the quant teams to both, get in tune with using more data science, not only the algorithm-driven teams.
I think we have time for one more question. Sorry. Yes, on the side. Yeah.
Marco was also talking about a dollar bear market, which is inflationary again. You have less independent Fed that will cut rates, inflationary. The fiscal has been inflationary. Do you think a second wave of inflation is coming? And if so, what should the administration do to do its best to fight it?
You get all the tough questions.
So yes, and just not raise tariffs would be the simple answer. I don't think that we're headed for anything close to what we saw a couple of years ago. With that said, over the next 6 months, it looks likely that inflation will trend higher, on a sequential basis, on a year-on-year basis. And to put it, to sort of boil it down, without the tariffs, and we could do immigration separately, but without the tariffs, you probably would end up with core inflation late this year, so like at the end of the year, at something not much more than 2%, maybe a little bit higher than 2%. With the tariffs, we're probably over 3%. And so I think we're going to get, and then on the labor market side, you'll have presumably a slowing labor market. Now, the immigration piece of it, I don't think actually means that much for inflation, because while you will have some bottlenecks, and there are certain sectors where you actually can kind of already see it a little bit, like some construction stuff. Those are also consumers who are no longer consuming. So it works in both directions. But I think the real test is going to be late this year if we have job growth, let's call it like monthly payrolls running at like 50,000 or something a month, which is kind of in the range of what we're imagining. And at the same time, you've got inflation maybe on a year-on-year basis above 3%. And then you've got President Trump urging Powell to cut. I actually think that Chair Powell is probably going to be more concerned about the growth impact from all of these policies than the inflation impact. Because inflation, it is a sort of a price level change. It's not necessarily an ongoing inflation. But at the moment, it's going to be a little bit harder, I think, to distinguish what is temporary and what's not. Longer run, I agree with you. So the dollar seems likely to decline pretty substantially further from here. How quickly that happens is unclear, but it's still probably 15% overvalued or something like that. And so that will have an inflationary impulse. And we also aren't done with the tariffs. Right now we probably have done something like 2/3 of what we're going to get. We haven't seen much of that impact yet, and we haven't seen all of those tariffs yet. So this is going to be with us for a while, and the risk is just that people look at this and that the public can't distinguish between what is a temporary, essentially, increase in prices because you're just passing through some tariffs and then you're done, versus, like you said, a resurgence of inflation again and bringing back up the fears that we're going to have something like we had a couple of years ago.
And cutting rates in that context, I guess there's a bit of a danger.
Well, so I think, the next meeting's in September. We're going to hear from Powell tomorrow. My sense is that Powell would want to protect against the risk of sending too dovish of a message, since the market's already pricing, a decent amount for September. And the one big problem he would have is it is a hawkish surprise. Like, that's the one thing presumably he really wants to avoid. With that said, like right now, the market's already pricing a decent amount between now and the end of the year. I think it's reasonable. And our baseline is actually 3 cuts. But that third cut, is going to be a challenge, because at that point, toward the end of the year, you are going to have higher measured inflation, lower job growth, and a real quandary for the Fed. The good news is, once you get through that period, I think it's probably going to be a lot, I don't want to say easy, but easier, because growth concerns will have probably faded a little bit by early next year, and the inflation impulse will at least be kind of more sideways at that point. So it's this next several months is like, basically sort of September to December seems like it's going to be the trickiest period that we can see over the next 12 to 18 months.